Welcome to vTalkInsight, Market Drivers Daily for January 30th, 2026. AI infrastructure spending, a run at hot growth backdrop, and sharply divergent earnings reactions are all colliding today, and together they are rewriting how markets price risk across sectors. Let's get straight into how the AI build-out is evolving and what that could mean for market leadership. AI is shifting from a simple growth story to a much tougher capital allocation filter, where markets increasingly reward only those companies that can show clear revenue and profit traction from their spending. Massive investment plans across big technology and infrastructure names are extending the AI cycle, but they also magnify risks around overbuilding, concentration, and supply bottlenecks that could define equity leadership over the next few years. Mega-cap platforms are still stepping hard on the accelerator. Meta is contemplating up to $135 billion of capital expenditure this year, close to a 90% increase, explicitly to fund AI data centers and related infrastructure. Microsoft has already lifted its own Capex by around 66% year-on-year to roughly $38 billion in the latest quarter, while Tesla plans about $20 billion of spending as it pivots from pure autos toward AI, robotics, and even its own chip manufacturing. On top of that, Elon Musk has floated another $20 billion for foundry capacity, and Amazon is reportedly weighing a $50 billion commitment to OpenAI, illustrating just how capital-intensive this race has become. This wall of spending is flowing straight into semiconductors and physical infrastructure. Chip equipment makers such as ASML are sitting on record order books with backlogs close to double quarterly revenues, while memory producers like Samsung and SK Hynix are ramping output to meet AI server demand. Storage specialists, including Western Digital and SanDisk, have reported strong earnings beats and upgraded outlooks, with some enjoying historic gross margins because new capacity is scarce and AI workloads need far more memory and storage. Industry-wide, shortages in silicon, high-bandwidth memory, connectivity, and even power supply are now seen as the main brakes on AI data center expansion, suggesting the build-out could run longer and more steadily than a typical tech cycle. In contrast, the software side of AI is seeing a much more mixed market reaction. Enterprise players like SAP are pushing hard, forecasting at least 23% cloud revenue growth in 2026 and embedding AI agents across their product suites, while keeping an open architecture to models from providers such as OpenAI, Claude, and Mistral. Yet, SAP shares still dropped by more than 10% after cloud backlog growth underwhelmed and investors focused on the risk that large language models could commoditize parts of traditional software. Microsoft, despite a solid quarter, is also under scrutiny because roughly 45% of its $625 billion of future contracts are tied to OpenAI, and investors worry about both margin dilution and single partner dependence. Beyond big platforms, AI is moving rapidly into real economy workflows. Surveys suggest over 40% of senior executives already have AI agents in production, mainly in information technology and code creation. Manufacturers are using AI to optimize direct procurement and supply chains. Financial infrastructure providers such as Nasdaq are weaving AI into every product roadmap for risk management and compliance, and healthcare systems are adopting AI to cope with chronic labor shortages and more complex conditions. In pharmaceuticals, AI-driven discovery has reportedly doubled early-stage pipeline output, while large partnerships like NVIDIA's billion-dollar deal with Eli Lilly highlight the scale of capital now chasing AI-enabled therapies. The AI build-out is also spilling into commodities and macro. Copper has surged toward $14,000 a ton, while gold is up about 30% and silver more than 60%, helped in part by expectations of sustained data center and electronics demand. Industrial names, such as Caterpillar, are reporting earnings beats tied to power generation units for AI data centers, and private equity firms like Blackstone highlight surging appetite for data center assets. The counterpoint is that such aggressive Capex raises the risk of eventual overcapacity and valuation air pockets, particularly for names like NVIDIA, whose outlook is tightly linked to AI enthusiasm, and for software incumbents whose business models could be eroded by cheaper AI tools. On top of that, energy and grid constraints in the US and Europe, export frictions such as China delaying orders for NVIDIA's H200 chips, and the heavy reliance of some platforms on a single AI partner all represent meaningful execution risks. Looking ahead, the key questions are whether reported revenues keep pace with the exploding AI Capex, and which parts of the stack capture the bulk of the economics. Upcoming earnings from chip equipment makers, memory suppliers, and cloud software vendors will help clarify how much of today's spending is translating into durable cash flows versus simply inflating order books. For markets, the current pattern favors hardware, energy, and data center beneficiaries, while being much more selective across software and platforms. As this AI cycle feeds directly into growth data, it sets the stage for a broader discussion about how hot the macro environment can run. The growth narrative continues to tilt toward upside risk, with both macro data and corporate behavior pointing to an economy that is running hotter than many expected, even after earlier revisions to headline numbers. Recent days already highlighted a powerful combination of AI Capex and rearmament spending, and the latest information reinforces that story with broad-based strength in consumption, investment, and labor markets. Starting in the U.S., consumer demand remains robust despite weak sentiment surveys. Real spending has been growing at or above 3%, helped by fiscal stimulus, tax rebates, and still strong job creation. Initial jobless claims sit near 209,000, with a 4-week average around 206,000, while the unemployment rate has stabilized rather than spiking. Small and mid-sized businesses, which drive the bulk of hiring, are responding to lower borrowing costs by adding staff, and more than 5 million new business applications over the past year point to striking entrepreneurial dynamism. On the investment side, corporate capital expenditure has risen about 6%, with upside surprises from names like Caterpillar, which reported roughly $19.1 billion of quarterly revenue against expectations below $18 billion. Part of that strength comes from demand for power generation equipment tied directly to data centers, underscoring how AI infrastructure is feeding back into traditional industrial sectors. Outside the U.S., German infrastructure spending is picking up, with improving orders in transportation and construction, and the U.K. is expected to see faster merger and acquisition activity through 2026 as companies with solid balance sheets seek inorganic growth. This investment and demand pulse is echoing through commodities and healthcare. Copper prices have climbed close to $14,000 a ton, supported by speculation in China and expectations of stronger U.S. growth and infrastructure outlays. More broadly, gold is about 30% higher and silver more than 60% higher, reflecting both physical demand and the capital intensity of the AI buildout. In healthcare, booming demand for GLP-1 medications, helped by price cuts from around $1,800 to about $149 and new approvals spanning heart, kidney, and liver disease, is expanding the sector's addressable market. Emerging markets are expected to enjoy a solid year as well, with local fundamentals and global flows both supportive, and political events in countries like Brazil and Hungary seen more as opportunities than as destabilizing shocks. A key structural change behind this growth narrative is the shift from monetary to fiscal dominance. Coordinated government spending, including tax cuts and targeted support for families, education, nutrition, and health, is becoming a central driver of activity in developed markets. Combined with robust private sector investment, this has pushed long-term return expectations for a classic 60-40 portfolio up from around 4% to roughly 6.5%, as investors factor in higher real economy investment alongside more active fiscal policy. At the same time, strong corporate profitability and productivity gains are expected to remain dominant market themes into the second half of the year, reinforcing the idea that earnings growth can coexist with only limited central bank easing. The counterpoint is that such a run-at-hot environment carries clear risks. Some observers expect productivity to keep inflation contained, but others warn that if nominal GDP drifts toward 4 to 5%, wage and price pressures could re-accelerate, especially with commodity prices already elevated. PIMCO, for example, anticipates only 1 or 2 Federal Reserve rate cuts this year, reflecting concern that resilient growth and sticky inflation will limit the scope for easier policy. There is also a K-shaped element. Fiscal stimulus and asset gains support higher-income households, while lower-income groups still face financial stress, even as AI-related disruption creates both new opportunities and job displacement in select sectors. For markets, that means watching whether higher yields are driven primarily by stronger growth, which tends to be more benign for equities, or by a jump in term premia and inflation expectations, which could prove more disruptive. Looking ahead, the main watch points are upcoming payroll and inflation releases, revisions to growth estimates, and whether China follows through on easing property restrictions that could further lift metals demand. Investors are also tracking how quickly infrastructure and AI-related projects actually break ground, and whether policymakers lean into or lean against this momentum. So far, the combination of strong demand and rising Capex is feeding through into better corporate results, which brings us to how earnings season is amplifying and sometimes challenging this growth story. Earnings season is helping to validate the macro resilience narrative, but it is also exposing sharp divergences in how markets assess AI strategies and capital allocation. Corporate profits in the U.S. are at record highs and expected to climb further, with productivity improvements and solid demand providing a supportive backdrop. Yet investor reactions have become more discriminating across sectors and even within mega-cap technology. Among the large platforms, Meta stands out on the positive side. The company delivered strong revenue growth, guided top-line expansion in the mid-20s to mid-30% range, and linked its aggressive AI spending directly to better ad targeting and higher engagement. Markets rewarded that clarity, with the stock jumping around 8 to 10% in pre-market trading and price targets moving higher despite the enormous Capex plans. Apple, by contrast, reported a record quarter with roughly $143 billion of revenue, about 16% top-line growth, and iPhone sales up more than 20%, including a sharp rebound in Greater China. Even so, the share price reaction was muted and the stock remains an underperformer among big tech peers, as investors continue to question its AI roadmap, its reliance on Google for core models, and whether a hardware-centric approach can sustain growth. The clearest earnings winners so far are tied to AI hardware and infrastructure. Chip names such as STMicro have issued sales outlooks above expectations, and semiconductor equipment makers like ASML report record orders as memory players boost Capex for advanced AI chips. Western Digital and SanDisk both posted strong beats and raised guidance, with SanDisk enjoying unprecedented pricing power and historic gross margins thanks to sector-wide supply shortages that are expected to persist until new capacity appears in roughly 2 years. Caterpillar's earnings beat, driven in part by demand from data center-related power generation, and Blackstone's record quarter on the back of strong data center deal-making, further underline how AI is creating tangible winners well beyond pure technology. Outside the AI complex, earnings strength is broadening into cyclicals, travel, and financials. ING Group reported profits above expectations and lifted its 2027 profitability guidance, helped by strong commercial momentum, robust loan and deposit growth, and a record 23 billion euros in revenue. In travel, Royal Caribbean raised guidance, with about 2/3 of its 2026 cruise capacity already booked, while cruise lines and airlines such as Southwest have rallied on better-than-expected results and signs of sustained demand. Consumer names like Starbucks, with 4% sales growth and around $2 billion of identified cost savings, and Deckers, which beat estimates and upgraded full-year guidance, point to ongoing strength in discretionary spending. Nasdaq, meanwhile, beat on both revenue and earnings, with about 12% full-year revenue growth and a strategy that uses AI to enhance engineering productivity and client solutions rather than simply cutting headcount. Yet the earnings story is far from uniformly positive. Microsoft stock fell more than 7% despite solid numbers and robust guidance for the March quarter, as markets questioned whether its record AI-related Capex is outpacing revenue growth and focused on the concentration of Azure backlog in OpenAI deals. Software sentiment more broadly has deteriorated, with names like SAP and ServiceNow selling off on concerns about competition from AI-native challengers and uncertainty around the payoff from large-scale AI investments. Tesla illustrates another dimension of risk. The company is aggressively shifting from low-margin autos toward AI, robotics, and energy, is phasing out legacy S and X models, and command a valuation above 150 times forward earnings that is heavily anchored in long-dated AI narratives rather than near-term fundamentals. Across sectors, there is also a question of sustainability. Apple's double-digit iPhone growth, SanDisk's extraordinary margins, and Cruise Line's record bookings may be hard to repeat if growth slows or input costs bite, while AI-driven disruption continues to challenge traditional business models in finance, insurance, and software. Looking ahead, the rest of earnings season will be crucial for gauging whether today's strength broadens beyond AI-sensitive names into more neglected parts of the market. Key signals include whether companies can keep surprising on revenue rather than just on cost cuts, how margin guidance evolves in sectors facing rising wages and input prices, and whether investors continue to reward aggressive AI Capex or start demanding clearer proof of payback. So far, the balance of evidence points to solid profit growth, a still supportive macro backdrop, and a market that is increasingly selective about which AI stories it is willing to underwrite. Bringing these threads together, AI remains the dominant driver, but it now operates within a broader run-at-hot growth environment and a more nuanced earnings landscape. To sum up, AI Capex is still powering a long-dated investment cycle, but markets are drawing sharper lines between hardware winners, disrupted software models, and platforms that can or cannot turn spending into visible growth. The macro backdrop remains skewed towards stronger growth, with fiscal policy, Capex, and productivity all supporting demand, even as inflation, inequality, and overinvestment risks require careful monitoring. Earnings season, so far, confirms resilient profitability across technology, cyclicals, travel, and financials, yet reactions are highly selective, with valuation and the clarity of each company's AI strategy determining who outperforms. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.